A very good morning to all of you. I'm the faculty from the School of Finance and Commerce, going to conduct a lecture on mutual funds. So this is the fresh topic which we have taken up for today's discussion. So let's begin with it and what all comes under the mutual funds. Now, these are the prerequisite as in order to understand this particular session. One should have the basic understanding on what is financial services and what are the functionings of financial services, as well as one should have understanding on what is financial organization, as well as required or must to have knowledge on financial market. Now these things are being required in order to understand this session. Now coming further, these all things we are going to cover today will start from the meaning of mutual funds. With the meaning of mutual funds, we'll be explaining first of all with the help of example in the layman language. And then we come up and trying to explain the specified definition of mutual funds. Now we are also going to discuss on how mutual funds work, because this is very much important to understand for the students how the mutual fund works, and later on the discussion will be on the types of mutual funds, the availability of mutual funds in today's scenario. So these all we are going to cover one by one. So let's pick up one and then try to understand it. Now let's try to understand how this mutual fund is all about. Firstly, let's assume there is an individual. An individual is having some sort of money, and that sum of money is quite big, very small to spend in the stock market or in any other kind or in the secondary market. So let's say if I talk about the stock prices of such companies, if I talk about the invoices, it is costing 2,700 per share. Other one, the SBI, it is costing 2,200 shares, whereas L&T is being showing rupees 1,400 and the Grassims is being showing rupees 2,800. But the amount which individual is being having is only 3,000 rupees. But although that person is really and very much willing to spend on, so what that person supposed to do? Now, imagine an investor who has only 3,000 to invest. How does he invest in all the major stocks such that he creates diversified portfolio? So this is the ultimate willingness of an individual to spend in a market. Now further, if not just one individual, if we in different places, many individuals we could find they have money, but the amount of money which they are willing to spend is small, and such kind of individual we could find in many places. They are willing, but they are only having small amount of money, and they are not going to spend because the amount is being small, and that is not worth it to spend in a market. Now what will happen in this case, that there could be many such investors who have small capital amount to invest, then they can not buy stock diversified manner. So since there are, we could see there are three individuals, those are willing to spend in the market. Now here comes the function of the fund manager. The fund manager is one who is actually specialized and knowledgeable where to spend, how to spend in the market. So how that fund manager is going to manage all three individuals, those are having very small amount of money. So let's look into that. Now thereby the story moves around that that specialized, or I would say the technical person who have in-depth knowledge of the market, what that person will does, who's we call the fund manager. The fund manager is going to pool all the money from different investors. The investor who are having the small amount of money, they are going to collect all the money and going to spend in the stocks, because the amount of money is now, earlier it was only the 3,000 by each individual. Now after collating it becomes the 9,000, and the 9,000 would be the sufficient money to spend in a market as a beginner. And also to note that fund manager would have such a knowledge and such a depth of a market, where to spend, how to spend, and when to spend, that will definitely lead towards the profitability in the future. Now, what the fund manager will do? The fund manager is going to spend all the money in that. Since we know the invoices, if the fund manager will try to spend in all the uh, different stock prices belongs to different companies, because the performance of each company will be different from each other. And since the performance is being different, same as the share prices fluctuation will also vary. Now in that case, the pooled money which the fund manager is being having, it is 9,000. Now out of the 9,000, how the fund manager would spend? 2,700 is going to spend in the invoices. Further, for per share. Now further, there are 2,100 would be spent on the SBI and 1,400 would be spent on L&T, and thereby in the Gracian 2,800 would be spent on. So that makes the total sum is 9,000. So this 9,000 has been spent by the fund manager in the diversified portfolio. And when we talk about the diversified portfolio, is something within that portfolio, if one share is not been performing, but at the same time could be the possibility that other companies and other stock prices are being giving returns. So the game is all about the returns. How far extent the companies is going to perform and give the returns to the investor. Since the fund manager is having all the information, the depth of the market, he would decide and spend accordingly the money of the different small investors. So that, and the ultimate promise of the fund manager is to give the returns to the small investors. So this is all how the small investors also can generate the money with the help of the mutual funds. Available mutual funds, as in given this example, is of Infosys, SBI, L&T, and the Gracias. Now, further, what we would see, the investor put together hold one share each of Infosys, SBI, L&T, Gracias. So this is I just discussed about. Now, what it denotes? Concretely, it would say that effectively each of them holds 0.33 shares of each company. How? Since we know there are three individuals who have spended 3,000 per head, so obviously that makes out of the one share, the proportion of one investor would be 0.33 shares of each company. So this is how the all basic calculation we have, and the ultimate role is of the fund manager in order to collecting it and spending it and giving returns to the investors, basically small investors. Now, this concept of the mutual fund where the investor combine to pool their money and invest in a fund who then invest into securities on their behalf. So the fund manager is going to spend all the money which he or she has collected from various individuals, and that later on will be spent it in the diversified portfolio of the stock market. Now this is how the fund manager would perform, and on his behalf there would be the, and investors are also going to put faith on the technical knowledge and the depth of that fund manager. So this is how the basic understanding we have all about the mutual fund. So what the mutual fund will does, mutual fund, it actually take out, it is actually the pool of money which is being generated by the fund manager. And this is the money of the various investor, various small investor. Based on the knowledge of investor, based on the knowledge of fund manager, the fund would be invested in the market. So what we can say in defined term, in specified terms about the mutual funds. So we would say a mutual fund is trust that pools saving of number of investors who share a common financial goal. It means upon the mutual funds, investors have to keep faith on the fund manager while giving all the money, all the small amount of money to the fund manager. And that faith will definitely come out with in the form of benefits and in the form of returns to the various individuals. So this is how the even a small investor by the way of the mutual funds gets the opportunity to invest in a market. Otherwise, in earlier scenario, the people who have large amount of money, the big amount of capital they are having, they only would be able to spend it before the introduction of the mutual funds. Now, the money thus collected is then invested in capital market instruments such as shares, debenture, and other securities. So, various financial instruments within the capital market is being available upon which the fund manager can spend, or those instruments can be incorporated in the portfolio of the fund manager. The portfolio created by the fund manager, within that various instruments can be involved in. And various individuals have various risk and return taking power. So based on the risk and return taking power, those instruments is being included in the portfolio. Some are risky but give the high return. Some are less risky but give the lesser return. So as another aspect on the, I would say the flip side is that it is also dependent upon the investors as well. How far extent the investor is willing to spend in the market, and as well as how far extent the individual is having a capability to take a risk. Some are risk averse, some are risk taker, and some are moderate risk taker. They always communicate, the investors always communicate their preference to the fund manager, and accordingly the fund manager is going to construct the portfolio, and within that portfolio, as per their requirement, as per the depth of the investor, the fund manager is going to generate the return. But that would be really well communicated to the fund manager in the beginning. The income earned through these investment and capital appreciated realized are shown by its unit holder in proportion to the number of units owned by them. So as I told in the given example, 0.33 was the share of one individual in one share of a company. So accordingly, as they have invested, accordingly they would be reverted with the returns. Who would be reverted? The investors would be reverted with the returns. Now, when it comes to how the mutual funds work, we also need to see that. A mutual fund is a company. So you would find there are n number of companies are being available. They are dealing into the mutual fund, which is, and other way around we can put say it is a SIP. It is a systematic investment plan in which the people with the small amount of money they are going to spend in. So how does it work? A mutual fund is a company that pool money from many investors, invest in the money in stock, bond, short-term, money market instrument, other securities or assets, or some combination of these instruments. Further, the combined holding the mutual fund own are known as its portfolio. So when the fund manager creates the portfolio, within that all type of instrument is being there, short term as well as the long term, and also the risky instrument as well as the less risky instruments are also being there in the portfolio itself. And accordingly, the investment would be made by the fund manager. But the initial request is definitely raised by the investor to the fund manager. Each share represents an investor proportionate ownership of the funds holding and the income those holding generates. Now how this circulates, the money would start moving from the investor side, investor, and what the fund manager will do is then it will move towards the fund manager. Fund manager would have the collated money, then it would be spent it in the various securities depending upon the risk and return and the attitude of the investors. Further, when these securities will definitely generate the returns, and those return would be passed back to the investors as per the proportion of the money they have spent. So this is how the mutual funds works. Now, lastly, when it comes to the types of mutual fund, definitely it is being based on the basis of execution and approach operation. Another category is on the basis of the yield and the investment pattern. First is talking about how it will be operated and executed. Close-ended, within that, close-ended funds are being there, open-ended funds are being there. Other categories talk about the investment pattern and the yield. Yield talks about how much one mutual fund is having a capability to generate the revenue, generate the income. Investment pattern talks about the long term, short term. So there are n number of options are being available in the mutual fund in which the people or the investors can spend it. Since the investor doesn't have the much knowledge, they only can convey their idea and the thought of the investment to the fund manager, but ultimately the fund manager have specified depth knowledge about the various mutual funds. So we have income funds, which talks about only income generating power it has. Growth fund. As the company growing, the investors fund will also grow. The invested investors fund will also grow. Balanced fund, where the significant one side the income is being there, the growth is also being involved in it. Specialized fund, for the special people, specialized fund is also being there. Money market mutual fund, so this is for the short term purpose, the mutual funds are being available. Taxation funds, there are such kind of funds which would give the benefit of taxation on the money, that is also been there. Leverage fund, which is actually the will have the power to generate the borrowed fund, that is also dual fund. So within that, the income and the growth fund, both two kinds of funds are being within mix of that. Index fund, as per the index the funds are being available. Bond fund, it is quite less risky funds, mutual funds are being available. Aggressive growth, companies who are very much into the high growth pattern, so such growth aggressive growth funds are also being available. Offshore, and then further categories we have offshore mutual funds and other categories are also being existing. So these are the various kinds of mutual funds or categories are being available as per the income generating power and the investment pattern, and all are being upon all kind of mutual fund is being spent by the fund manager itself, and the generated revenue or the return would be revert to the investors. So these are the references I would say I have referred in order to continue or in order to prepare this particular session. And I hope everyone has well understood the session. And now on this note, I would like to thank you very much to all of you. And thank you very much.